economy, what's happening on the sentiment side, what are institutional money doing, what is retail traders doing. Let's take a look at seasonality, all of these data tools. We build software here at A1 Trading, and we want to let you try our tools for 30 days. If you're interested in doing that, you can apply for an Edge Finder trial using the link being dropped in the chat right now. And with that said, guys, we're going to take a quick break to thank our sponsors. And then up next, the Pulver Show starts now.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey everybody. Happy Thursday. And markets closed today in honor of Jimmy Carter. And we'll come back for non-farm payroll tomorrow. I just want to just go a little top down. I've been doing some pretty active trading this week. If I go to the Discord channel for me, we've got index trades, commodity trades, Forex trades, stocks, options trades, futures trades. I'm just going to poke through and give a little summary. I put in a new trade this week on IWM. My trade on the SPY was new. So I've got a new trade on IWM, new trade on SPY. My hedges I closed out in December through the holidays. Commodities, I did a trade on UNG. Forex trades, I'm still riding. Dollar CAD long, dollar Swiss long hit profit targets. We'll see if those get reached. Dollar CAD hits 44.80 tomorrow. If it does, then I'll get profit on about 7 positions long dollar CAD. Stock options pretty busy this week. Microsoft new trade, Amazon new trade, Micron new trade, Snap new trade, Nvidia new trade, Palantir new trade, TLT, that's a bond play, new trade, Pfizer new trade, Uber new trade, Coinbase new trade, futures market got into silver yesterday. So pretty active way to kick off the week. If you're interested in those, like you saw in the little the split promo there, check it out with Pulver Reports and grab yourself an Edge Finder, or at least trial the Edge Finder while you're at it. Speaking of markets and trade opportunities, I'm hoping that by Friday enough time has passed for me to get some extra profit on my SPY and SPX trades. I still think we're going to be dealing with some sideways chop here, so that's fine. Markets aren't really sure where they want to go. You know, we're approaching highs in dollar CAD, right? That's where I'm getting profit. There's my dollar CAD. I want there to be profit. So this is where, if we have a non-farm payroll spike, that would be perfect. And that would be a very typical thing. I'm sure there's traders that are lining up to sell right now that have been stuck in this trade for months. I've been long. And if we, test this level, hit these highs, you get my profits taken, that's great. I want closing out 1, 2, 3, 4, 5, 6, 7 trades. 1, 2, 3, 4. Took one off. So that's 4 and 7. I've got 10 trades running long to that profit target. So I hope non-farm tomorrow with the CAD and the dollar spikes up here. I don't think we have to stop right at 4,500. I think we can end up getting back to that 2020 and 2016 high, which is up to like 46 and change. But again, measure my move, pretty conservative, pretty happy with that trade overall. Dollar Swiss, same thing. We're at 91.16. My take profit is at 92. So if we have any pullbacks, I'm still going to add to this position. If we get another thrust on the dollar, I'm getting a nice little profit at 92. Dollar index, I don't think this is something I want to fight. If there's any dips on the pullback, dips here, I'm buying more. So I think as long as the dollar stays above 106 or 105.50, it is still a buy trade. I think the dollar, and this doesn't mean good things for the equities market, but a dollar getting stronger means that the 10-year yield is still going to be pushing higher, that there's the inflation risk out there in the U.S., whether it's sticky or not, we'll find out more next week. So we have non-farm payroll tomorrow, and next week on Wednesday, Thursday, I believe, I go FOREX Factor calendar here. Let's go to next week's trading. So we have Tuesday PPI, we have Wednesday CPI. Again, you notice here, it's probably by design. There's no forecast yet. We'll find out when the forecast is. Maybe it's Friday, maybe it's Sunday, Monday. But I'm interested to see, like, what is the year over year? What is the month over month? Is inflation still getting stickier? Does this have any impact on the Fed? I mean, I don't think we're going to see a huge drastic improvement in inflation. Um, if we print higher, that's probably not good either. If anything changes, it would just probably cement the idea that the Fed is likely not cutting much. Maybe one cut in 2025, maybe no cuts. Maybe if inflation is high enough, maybe there's that talk of a hike, which I don't think the market's going to like. So anyway, dollar index, I still think it stays bid. This would be an unfun trade. Okay, if the dollar gets stronger, if obviously you're participating in dollar strength, that's fine. Euro dollar heading towards parity. Okay, cool. Um, but I think if the dollar heads up here, what I'm more excited about is not necessarily taking like the extra strength in the dollar, but more so when and if this ends, taking the collapse of the dollar. That to me is going to be a bigger, more profitable trade with a price pattern that we can see and get confirmation on, and then measure a trade. you know so if all this was is waiting, get a price pattern, and then trade like some type of measured move head and shoulders, and you can do that on 6 currency pairs or 7 currency pairs, there's a lot of money to be made. So let the market do its thing. I'm not that interested in chasing dollar strength after this was already a very profitable trade. Like, that was me getting into dollar strength off of support. At this point, it's kind of, to me, it's kind of ran its course. Could it go higher? Yeah, of course. The dollar can still get stronger. To what degree? Maybe euro dollar heads to parity or lower. Maybe we revisit the 2022 lows at 96. Maybe the pound dollar gets below 120 again. Maybe it heads down to 110. The pound dollar did not hit parity. That'd be pretty awful if it did. So anyway, we'll see. But there will be some type of ramifications globally, trade wise, imports, exports. This is the milkshake theory. If the dollar gets super strong, all the global liquidity is drying up, and that means tighter markets. So anyway, that's the dollar. We'll go through some currency pairs. Let's go through a few more things. SPY, again, watch your levels. Basically, we have the FOMC breakdown, PCE low, tested during the holidays. You had a kind of the, I guess if you're going to call that the Santa rally, the Santa rally was PCE just shy of the FOMC breakdown. And then we pulled back and we pulled back. So it's just kind of narrowing right now. A little bit of this and a little bit of this. So, I mean, I guess you could argue either way that maybe this is still seen as an accumulation zone for the market to go back up. Maybe. I found, let me see here. I found this, which I thought was kind of interesting, coming into a new year and a new presidency and a new party. So Republicans taking over executive branch as well as judicial, right? So we've got Congress, Senate, House, and President, all Republican, and Democrats lost. So post-election year, after an incumbent party loses, again, this is a lot of data, which is why I like this. So this goes back 74 years, 75 years. And even if you started with all post-election years, which is in green, Q1 post-election years. So this would be, 2024 is election, 2025 is the official year. Q1 is not that exciting. In all election years, is not that exciting. But in a switching from Democrats to Republicans or Republicans to Democrats, it's a little bit worse. So Q1 is typically not great. Now, I don't know if that's going to be the case again. This is obviously aggregated over 75 years, but there is potentially a dip coming in Q1, which would offer a buying opportunity. And then again, maybe a dip coming into Q4. Okay. So could this be, a challenging year? Yeah. I think that if we have a move of, I mean, we've only moved like 3 to 4%. So, I mean, I think traders look at this like, oh my gosh, what's going to happen? I mean, this move right here is only about a 3 to 4% move. So there's a lot of potential flexibility and elasticity in the market to give us, let's say, like a 10 to 20% swing. And I don't know where that swing is. I don't know if that's up or down. I don't know if it's down first and then back up and then we settle in the middle. I don't know if it's down first, down further, and then we settle with a little bit of recovery. Like, I have no idea what's going to happen. But, operating in a 3 to 4% range is likely not going to be what the market does all year. I think we're pretty much in agreement. Like, the market's not going to stay sideways forever. If the market did stay sideways within like a 10% window, that happened back in 2015 and 16, I could see something along those lines. It's going to be obviously something we'd have to trade. Like, if we hit these lows and do them again, well, that would be support to trade. And then until we break those highs where momentum's getting stronger, like, find support, trade support. You know, manage your trades. I'm not doing a lot of stuff that's long term. The trades I'm out to like 2026 on or 2027 on, I am also selling options against them to lower my cost basis and also turn those into income trades. So if I'm, for example, TLT, if I believe TLT longer term bonds can go up, then what I'm going to do in the next 2 to 3 months is I believe they can go up. So I want to sell against them to lower my cost. And if I take any type of income trade or profit, I'll just reestablish the position and keep doing it. So I don't know, but let's check the bond market. I mean, nothing's open today, right? Equities closed. I think we have futures market open a little bit, or we don't. Yeah, they're done. Like, there's nothing. Yeah, there's nothing going on. All right, so there's no market. That's cool. S&P strong rally may cool off in 2025. Analysts warn. Oh no, it's not like we haven't talked about it for 2 months. All right, so there's our levels on the S&P. Here are levels on the Qs that I'm watching. A little bit more volatility in the Nasdaq. NVIDIA kind of squashed the idea of NVIDIA CEO squashed the idea of quantum computing, which got really exciting there for like 2 weeks. And then it's like, yeah, quantum computing is like decades away. So that squashed it. NVIDIA had a big fake out this week. Second largest company in the world market cap wise, huge fake out at the all-time highs. And I still think the bar count is really meaningful, where this either pulls back to support levels or falls lower. I still like NVIDIA. I own shares of it, and I've got a collar in at 140 to 130. If it falls lower, cool. I'll lower the cost basis. If it goes higher, I get it called away for income, and I'll trade this based on the high premiums that it offers. So let's go. Equal weight. Not doing anything yet. I think if equal weight might be interesting to watch, like RSP, QQQE versus Dow. See how these look very similar? So Dow is price weighted. Equal weight takes away a lot of the clout from large cap. Market cap weighted, like the SPY and the Qs. You saw last year that it only required basically one stock to go up, NVIDIA, and the markets could still go higher. NVIDIA, Apple, Microsoft, those three stocks alone, if they were stable or up, the entire S&P, the SPY, the entire Nasdaq, the Qs, they could go higher. So it's impressive that it only took those companies to drag the market up, and then you got the Mag 7 and the top 10 on top of that. But at the same time, if those stocks start going sideways or start going lower, you can see the effect it has. So we should be happy that the SPY, for example, didn't drop worse with NVIDIA taking a hit the way that it did, right? I mean, NVIDIA from this high has dropped about 10%. And the stock market SPY, and that day was what? So this was starting from the 7th. Yeah, so 2 days ago. And what did the SPY do? The SPY is down 1.5%. So you can have one stock down 11+%. You can have the index down 1%. And I know, like, Frank and Nick and I talked about this a little bit this week. I'm probably going to participate a lot more in the indexes for that exact reason. Just less volatility. Always good trading opportunities, but less volatility. If I'm doing individual stocks, I have to be way more prepared for high volatility. I think stocks could be, you can get 20, 30, 40, 50% swings in stocks versus an index. Like, a big move in the index would be 10%. 10 to 20% is a huge move in the index, but an individual stock could have 30 to 50% swings, and most traders just aren't prepared for that. Okay. Royal Trades to see that their markets are expecting a lot from NVIDIA. I know, and it's probably expecting too much. I think it's expecting like perfection from NVIDIA and perfection from Mag 7, and it almost needs it. because the valuations we're seeing, the price to earnings, price to peak sales, but it's so high. Like the expectations are very, very high that the market has to keep delivering to justify these valuations. So historical price to earnings on S&P is like 17. We're at like 23 or 24. So we're historically high. We're stretching to valuations we haven't seen since like .com bubble time. Not quite as bad as what we saw during the Great Financial Crisis, but same thing like from 1999, 2000, 2001. A lot of those like frothy valuations on the indexes, and then 2021, 22, like post COVID when things got like a little bubbly, you know, and 2022 is that correction. So anyway, there's a lot of that going on. On top of that, what's the same? What's different? The big difference that I see is like what the bond market's doing. I'll go back to dollar, gold, silver, do some currency pairs here. But, Mag 7, Apple's down a little bit. I'm curious this week get Apple back on a non-farm rip to like 245, 246. I hope I can. Amazon, I put on another trade on Amazon out to March. Willing to own some more shares. I'm kind of liking this if it's like just a little correction here. What I don't want to see is if it's a big plop. So I do have shares of Amazon. This is an income trade. The shares that I have a covered call and a long put, so it's collared and protected. So if it goes down, I can lower my cost basis with it. But Amazon to me is still a stock that I'll continue to buy. Okay. We'll see. So anyway, Google. Quantum computing stuff didn't really affect Google too much. I like Google. I mean, I was long in all this chop here in the 160s, and that worked out pretty nicely. If it's range bound, I mean, if Google like comes back in to fill the gap in here, or comes back in to find these lows again, like this would not be a bad spot. I mean, again, trading wise, if we're not just making all-time freaking highs all the time, then where would I buy Google? Well, if it pulled back into this zone, I'd probably add some positions to it. We have dynamic support with all these moving averages. I'd take some positions there. If it went lower, there's lots of structure in here that I would buy lower. So like 170 or 150, 170 to 150, I like establishing some positions there, probably like 6 to 12 months out, and just take a Google trade. I don't know if we're going to get back to this level. If we did, I'd be a bargain shopper, but I don't know if we're going to get there. If this is going to, oops, white out. If this is going to stay dynamic, then we find, higher lows, higher low, higher low, higher low if we get a pullback. But if we don't get a pullback, then what does Google look like here? It just builds and builds and builds and builds and then breaks out. That could be the trade. Like this is just an accumulation stage to justify higher highs. Okay. All right. Meta. Meta has a really high bar count. Either this is sideways or this is going to also correct coming back into the 200 moving average. I don't know, but I'm just going to wait. I like Meta, doing some income trades on it. I actually might look at this one tomorrow to see if I can do another 111. I like the income trades. I might do this out to, let me see what I have in Meta right now. Meta, oh, it's already profitable. Well, that trade's done. Make sure is it in here? Meta, okay, that trade's done. I didn't put an expiration on this one, so this trade already took profit. Okay. I'll leave that there just for a reference point because the price levels I wanted to see, I mean, I think I issued this trade when we had that little decline in August and September. Once we had this August, September, I think I was putting in that 111 trade. So now that we're, $100 higher, it's like, well, I think I could get, it's like, do I want to own Meta? Do I want to put, 50K cash towards Meta? Not really. Be 25 or, 20K for my portfolio margin accounts. That's still like, I don't like Meta that much. But I don't know. I'll look at some income opportunities. Maybe a 111. We'll see. I'll talk about it more tomorrow. Microsoft, I like this one better. I've got some orders stacked out here and staggered out for a couple of expirations. Netflix, I love a pullback on Netflix. The king of streaming. Okay, it's one of the few services I'm still keeping. I canceled my YouTube TV this last week. They went from $40 a month to $85 a month in 2 years. No, thank you. Netflix going from like you know, a $5 DVD a month to now like $15 a month, or some are paying $20 a month. You can share and have 4K or whatever. That's whatever. That increase, I mean, I think people could justify like, yeah, I'll pay 15 bucks a month for Netflix or 20 bucks a month. But I watch like very little live TV. It's usually DVR, and I can't believe they just doubled my price. So it's like no different than the days of cable. You know, I grew up with a satellite when I had to put in like satellite G4 and watch the thing turn, and I get like 2 movie channels. So cable's a joke. You can watch everything like after the fact. You can keep, you know, an app gives you good highlights, whatever, it doesn't matter. Netflix, I like it, but it's an expensive stock. So it's hard to justify for me. Like, I'm not going to throw down, you know, control of 100 shares when it's an $875 stock. I will consider heavy discounts if I'm going to own shares. Otherwise, it is a dollar cost average situation. So we come back to a more attractive area, you know, put in 500, 500, 500, dollar cost average in, we go to all-time highs. You know, I take a $1,500 position and it goes up, you know, 40, 50%. Cool. Take a $2,000 position, same thing. Like, allocate, you know, 1% or whatever you're comfortable with. But I think Netflix is great. We get back to $1,000. Does Netflix split? Possibly, right? They might do a 10-for-1 split. So $1,000 price will split back down to $100, and then you would have more shares of Netflix. What might be a benefit is if you dollar cost average in and they do a 10-for-1 split, you might find yourself the ability after a split to control options, because if all of a sudden after a split you have, let's say that I at least buy 10 shares of Netflix. Okay, so I would allocate about, you know, let's say $8,000 to Netflix. I can justify that. If they do a 10-for-1 split, which I don't know if they're going to, but I would imagine for a, let's say, top 25 stock, that it's probably more, I'd say more probable than not, is if I had at least 10 shares of Netflix and they do a 10-for-1 split and all of a sudden I'm left with 100 shares, now I can control options. Sweet. I like that a lot more than tying up, you know, $87,000 in order to control options right now. Right. So thinking a little bit ahead, maybe there's a split down the road with the stock price being this high. Yeah, I like Netflix a lot. I think we have a really high bar count. I'd like to see some pullbacks, right? I don't know if Netflix is the type of discretionary thing that consumers would be like, I'm going to cancel my Netflix. I think for 15, 20 bucks a month, it's like people are going to keep it. It's one of those price points where most people just don't cancel it 20 bucks a month, 30 bucks a month, you know? So I hope they don't go. If Netflix is all of a sudden 40 to 50 bucks a month, sure. I personally would be like, I don't want Netflix. You know, there's other stuff I can do with 50 bucks a month. So, but I think if they stay in this like 20 to $25 window, maybe they'll stay there. You know, we'll see. Just add more subscribers. All right, Nvidia. Market expects a lot from Nvidia. I think we're still going to pull back towards the 200 moving average. Nvidia could have a very volatile year, for better for worse. You know, maybe it's still like the best semiconductor game in town. It's the easiest trade to just anybody wants to be in AI, invest in Nvidia. Anybody wants to be in AI, invest in Google. Like, that's the hard part about saying like, oh, the Mag 7 needs to change and the Mag 7 needs to give back some of the gains. They don't. I think the Mag 7 is like kind of become its own index, right? Like, they're so powerful, they're so big. I don't see them just getting broken up. It's like the government's not going to probe Google and be like, you guys need to become 5 different companies. It's already 2. GOOGL under the parent company Alphabet. It's already 2, and it's 2 of the largest stocks in the world. Mag 7 is like basically its own index. You know, if you look at what this market did, if you didn't have Mag 7 exposure in the last couple of years, you probably didn't make much money in the markets. It's that simple. So, is it important? Absolutely. There's, I don't know, like, this is an easy way to trade it. I don't know if I have options on mags. I hope I do, but they're probably like spread out and terrible. So mags, I mean, I have options. There's weekly options there. I bet the premiums are not awesome, but let's find out. If I owned, yeah, these are terrible. If I own, and this is like a incomplete option chain, but an at the money call for like $1 or $2, that's pretty crappy. So anyway, I was gonna say I'd like to, you know, own an index that represents the Mag 7. but trade options around it. I just don't think the premiums are that great. So if there's better ones, if anybody knows of other Mag 7 ETFs, let me know. But I can go Mag. So let's go Magnificent. So we have Mags. We have YMAG. And we've got, of course, the double leverage Mag 7. What's that doing right now? Double leverage Mag 7, 25 to 50. I mean, it's up 100% since March of 2024. No big deal. But double leverage, so it's pulled back around 15%. So again, I'm not touching this instrument. I was just curious. But let's go Magnificent. So Mags and YMAG. Let's go YMAG and see if that has any better options chain. YMAG. Terrible options chain, monthly only. And not even that if this fill in March for me, if I went out 43 days, this thing is absolute trash. So trading options around it is not going to work. Mags is better. It's not great. Mags is better though. Otherwise, of course, you have your individual stocks. They're just going to be more volatile, you know? So it's hard to think like there's going to be a lot of requirements out of Mag 7 to still be like the trailblazers and pioneers into whatever AI looks like. Whatever the AI future holds with infrastructure and tech, I mean, I guess the only competition would be that you trade private equity, because I don't think you're going to have companies that want to go public to compete against Mag 7 when they can be private and never require public funding and still make crazy profit margins on AI. Which there is one instrument that I'm in that is a private equity investment. I think I put that into my Pulver alerts. I don't remember what it is, but I'll find it. So something in the private equity space. PSP. Yep. So PSP right here. So I just bought some shares. I just put a little chunk into it. And it's essentially a way for public investors to trade private equity. Okay. So I bought some. I'm going to buy some more if we come back to the August lows of 2024. My target would be, 85 bucks or maybe $100 eventually. But I'm looking at, this is why I chose 84, because we were there back in 2021. So anyway, a little diversification. All right, let's talk bonds. 4.669. This is the threat, and I think it's silly. It's silly to think like this is like the frog in the pot. If we're just watching this go higher and higher, like how is there not more of like an active campaign to get the frickin' rates under control? This is the first time in history. Let me see if I can find this image here. I think I had to find it. Yeah. Okay. This is the average. So for the last like 40 years, okay, let's put our history caps on here. Let's go back 40 plus years to the yields versus the Fed cut cycles. The average bond rate, or the average bond yield, has gone down every time there's been a cut cycle. This is essentially the only time in history that the bond market, the yields are going the exact opposite. Like what the flying F is going on? Like that has to be triggering some major concerns. And I don't know how it stops. Right? I don't know how it stops. And so to me, this feels like the frog in the pot, where it's simmering. Like when this thing pivoted hard, somebody turned on the oven, and then it just started simmering, and now it's boiling, and it's like, how much worse does it get? I mean, are we going to see mortgage rates go to 8%? Are we going to see mortgage rates go to 10%? Are we going to see like an absolute bubble and break in the bond market before something actually gets fixed, when it's going to be a reactive change? It's so damaging to see stuff like that happen. But I will say this, just like in 2020, just like in 2008, just like in 2000, 2001, those crashes and breaks in the market are also the opportunities that create like decades worth of wealth. But you have to have the cash to deploy, or you have to have the protection in the portfolio to make sure that you're not getting hurt on the other side of that trade. And that's the one thing that I will be focused probably the hardest on this year is if we have an opportunity to buy at like just an obscenely great discount, whatever it is, bonds, equities, ETFs, I don't care, whatever it is. If we have an opportunity to create a position that could generate like just obscene returns over the next 3 to 5 years, I want to be that trader, right? I don't know what the opportunity is right now, but I'll be looking for it. Point is, I can't believe that we're sitting here watching this go the exact opposite way, right? The exact opposite way. And this is like the only time in history that this has happened. So for all the Fed cycles and all of the yields, this is our current cycle. This is what's happening right now. So for the 100 basis points, the 100 basis points that the Fed has cut, we are now 117 basis points higher in the 10-year yield, right? This market has moved 111 basis points, currently down, or it's at 107 basis points. It has moved like tick for tick, bip for bip, the exact opposite of the Fed. And I don't see this getting any better right now. So getting to 5%, this also doesn't mean that it has to stop there. So I put in this, I wrote this yesterday when Nick and I were on during FOMC minutes. Back to 5% could be troublesome and then things get better, but greater than 5%, it's like this is a runaway train. And I don't know if this is like the US is on the brink of like a pseudo hyperinflation environment or a stagflation environment that is not going to be under control, and then something breaks. That's probably my biggest concern in 2025. Okay. Doesn't mean I'm doom and gloom. It just means you got to be aware of something like this. Like this is a problem. There are very smart macro analysts out there that are like, I don't know how to model this for 50 years of data, 100 years of data. Like, I don't know how to model this because we've never been in this environment. Right? Is that a disinverted? No, that is just the yield overlaid with the Fed rate cycle. So when the Fed cut rates, right? So we go to the Fed funds rate, we raise rates, we cut rates. So this cut from this level, 100 basis points. So from 5.35 down to 4.5 or so, it's like we know that the Fed cut 100 basis points, right? They cut 50 in September, they cut 25 in November, and they cut 25 in December. Add it up. It's 100 basis points. But what has the bond market done? The exact opposite. Here's your 10-year yield. The exact opposite in yields. So the yields are going higher, which means everything is more expensive. If you want to borrow money for a car, you want to borrow money for a house, you want to refinance any type of debt, you got a business and you're borrowing, you have a loan, it's all more expensive. If anything comes to terms where your debt is going to be rolled over, you're borrowing at higher costs. The Fed is financing at higher costs, right? We're servicing debt at higher costs. Like that's more expensive. So point is, that feels like frog in a pot. We all see this happening. Nothing's changing to get it fixed right now. And I think the only way this gets fixed is like a freaking crisis. That's my concern. So is something going to break, or is it this easy? Is it the market gets up here, it becomes a breaking point, we see some pain in the equities market, and then the yield takes a breather? If we're lucky, maybe that's the top right back here, right? Because as this was happening, the stock market was falling, but what have we done? We've actually gotten this way with the stock market sitting at 3 to 4% off of all-time highs. Another concern, it's like, well, the stock market's not really cooperating the same way it did back in 2022, 2023. So anyway, that's it. We'll see. And one thing I've never seen over my career, 20 plus years in the markets, is I don't see the Fed usually navigating smooth, silky, soft landings. Usually the Fed is an entity that manipulates the markets because something breaks. They have to come in and backstop chaos. And so they are very lucky that the last couple of years that the market's still been able to ignore reality, get to all-time highs. People feel great about the economy. Not really. They feel great about the stock market, their 401ks, retirement plans, maybe. But the Fed hasn't had to do anything to really hard stop. The last backstop we saw with the Fed was the regional bank crisis in January 2023, right? Silicon Valley, which again, that's a byproduct of terrible bond mandates where you're supposed to keep bonds and bank holdings, and it's like they didn't have liquidity to meet depositors' needs, right? So they have to cash in bonds to get liquidity, and they do it at a loss because their maturity's 10 years out. So it's just a stupid system that they have to deal with. anyway, doesn't matter. Point is, this is where I think a problem could be. This is bubbling under the surface. Now it's in plain sight. Is like, how bad does it get? I don't know. The 10 and the 2 year, the 10 and the 3 month, this is the inverted yield curve. This is the longest and deepest inverted yield curve we've ever had, and we are officially out of it. So one more thing to talk about this, and I'll go into some Forex and some analyst stuff here, would be I go back, to 82. So we're at 42 years, 43 years now. What I put in was the timed vertical line is the recession. Okay. So when we officially had a recession, this is the period that it started. So it's not the inversion that is the problem, it's the disinversion and the borrowed time after it. Yes? So we invert, we disinvert, recession follows. We invert, we disinvert, recession follows. Invert, disinvert, recession follows again and again. And here we are now, the deepest and longest inverted yield curve, and we are now out of it. So that's why I put borrowed time. I don't know when the recession starts. You could argue that we're already in one. It's just not being acknowledged because people feel that it's not gotten easier, right? If life's more expensive, if people are, not making more money, the argument's like, oh, wages are up. It's like, where if you quit and get another job, or you pick up extra gigs and you're trying to work 2-3 jobs, like anyway, I think we're on borrowed time. And what we don't know is 2022 was a bear market. Yes. Okay. Was 2022 called a recession? No. Why was that? Well, because like one sector experienced it and then another sector experienced it later. And it was like this delayed, like hopscotch or leapfrog. I guess leapfrog's a better word. Leapfrog for recession, right? It wasn't felt all at once. It wasn't a 2008, right? It wasn't like everything is down. Markets were down, but different sectors, felt more pain than others, So anyway, if we have another full encompassing or full on, like everyone feels it, there's no place to hide, then yeah, that's going to be really ugly. But I still think you got to acknowledge this stuff. I don't know how this market just survives like nothing's going to change and everything's just going to be all-time highs forever. I don't think it happens. So 2025 is going to be a pivotal year to figure out like how resilient this market's going to be. And I wouldn't be surprised if we have 10 to 15 to 20% swings, for better for worse. So just be prepared for index volatility and certainly be prepared for higher volatility in individual stocks. Okay. All right. Let's talk currencies. Got some other stuff in here. China, still waiting on China to see if anything good from animal spirit side comes in March. The S&P stocks above their 50-day. I'd like to see if this can get down into like the 10 or 11 spot. This is like 10 to 11%. I think that's a good buying opportunity. If we have a little bit more pain in the indexes, this might get lower, and I'll be keeping an eye on this. So it's mainly this. I want to see like above the 50-day. If this gets down into the like 10, 11% level, or the Nasdaq 10, 11% level, then I look at that as an opportunity to buy. But I think there could be a little bit more pain ahead to see if that gets to a really low spot. And then I put on a new trade on Walmart this week. Costco, I'm going to wait for a dip and a pullback to dollar cost average into again. I'd love to see a split on Costco. I would gladly take a split on Costco. I rode this thing like, I don't know how long I've been a member of Costco, maybe the last like 6-7 years. I have been an investor like since like day one of membership, just because if you've ever gone to Costco, like you probably get it. You can spend a crap ton of money there, not wanting to, but you just do. You buy stuff that's not on the list, and so my solution now is I just buy stuff online. Like I go Costco online. I don't go to the stores because I'll just buy stuff that I don't need. Anyway, my problem, not yours. But as a shareholder, it's like this has been a pretty incredible run. It is overvalued. From a fundamental standpoint, here is Costco. The multiple this is trading at is pretty obscene, right? So I mean, a grocery store, basically a consumer defensive, trading at 54 times price to earnings is pretty darn high. Look at it versus peers. Now it says fair value over $1,000. That's cool. I'd like to get any chance of a discount. If Costco gets over $1,000, similar to what we saw with Chipotle. Chipotle was like a $2,000 stock and did like a 50-for-1 split. So I don't know if Costco does the same thing, but I would not be shocked if they did. But I look at this like the peer average is 21.4 price to earnings, and Costco is more than double that, right? Walmart's 37.5, BJ's wholesale 21.9, Target, Dollar General, for crying out loud, like way lower. So Costco is trading at a very, very high premium. So I would like to see a correction. I still think it gets to $1,000+, but it's like I'm hoping, based on a bar count. This is another one that has a crazy high bar count. I can count it exactly, or I can use my little Copilot thing that I made here. Where the heck is it? Bar count. Costco. Okay. Bar count is 406 bars, I believe. Let's make sure that's accurate. So from this level, yep. So we're at 406 bars. Again, on a daily time frame, that's a lot. That's a lot. So why is this weekly? I was like, that's way off. Here's a daily. Okay. That's a very high bar count. So do I want to see it hit the 200? At the minimum, yes. I'd like to see it hit the 200. If I put this on a weekly chart, is there kind of a convergence between, this is a 21-day weekly? I mean, is it possible to pull back to a 50? I hope so. But somewhere between, I mean, I'll just say like we'll say 880 or lower before I start looking at another allocation. I mean, I hope I don't miss it, right? If it goes up to $1,000, like, okay, I guess I didn't participate. But it's just too expensive for me to say, like, oh, I'm going to take like a ownership trade. I don't want to own 100 shares at $900. It's like that's way too much to get tied up, and their premiums aren't that freaking awesome anyway. If I go to Costco, look at their options chain. If I went out 30 days, what's an at the money? $20. I mean, it's a $900 stock. I mean, I can get $20 in, like, I'm trying to think, like, I mean, Nick got $20 in Tesla. So I mean, Tesla is a $300 stock versus a $900 stock. So I mean, the premium, I don't know, maybe volatility is better. It's only a 23.7 IV rank, but still, I'd like to get a lot more premium out of a stock that's that expensive. Okay. All right. There we go. So Costco, I'll get rid of that workspace now. Walmart, Nike, Home Depot, Lowe's, stuff on. Let me see if I've got anything on residential construction, total spending. No, I want to see residential construction job, not spending. Spending, fudge. So this is another, like, really good sign for a recession. And it's like the canary in the coal mine, along with a lot of other stuff we have. But residential construction. How does it not pop up? Maybe I just have to find a fancier website. Anyway, basically it's this: if residential construction jobs start going down, if there's like higher upticks in unemployment or layoffs in residential construction, that is not a good sign. Now, I think we're in a phase right now where, like, supply is trying to catch up in a big way. This is where the housing market is in jeopardy in 2025. Is there's so much emphasis on building supply, but you're building supply in an all-time unaffordable index. Like right now, the housing market is the most unaffordable in history. Prices continue to go up. Mortgage rates are continuing to go up. People aren't selling, or people that are trying to sell are trying to sell for top dollar, not getting it. So they're sitting on the market, or they're taking less money for their homes, and then they're forced to build into something that is more expensive. You're basically selling high and buying high. And so people aren't selling, right? If you are selling, it's maybe because you're downsizing. It's maybe because you want the crazy amounts of equity that's been in your house for the last couple of years. And put insurance on top of that. Yep. So, like, houses are expensive, man. And yeah, it's gonna be tough. So if supply is up, I mean, that doesn't mean the house prices have to come down. It's just gonna be a weird 2025 for, like, supply catching up, but mortgage rates and prices of homes are super expensive. All right, let's talk currencies. Let me get some comments here. I saw some requests. Somebody asked about euro yen. I'll look at euro yen. We'll look at some currencies. How do I get customer service of technical discussions. I don't even know what that means. What are you asking for? Pound US dollar. All right, let's do some currencies. Let's just go alphabetically. Aussie CAD. I still like the range on Aussie CAD. I'm going to dollar cost average into this one. So if we hit these lows, I'm buying more. We hit these lows, I'm buying more. My target on Aussie CAD is up here towards 98 to 1.00. Realistically, right now, I would even be willing to say Aussie CAD is a bounce here and trade it back up towards 90, about 91.50. So if we bounce here, I'm going to add more dollar or Aussie CAD. If we come down lower, I'm adding more. Like I will stay in this range in Aussie CAD for a while. Right now, Aussie CAD is also positive swap if it's a buy trade. The RBA is held rates at 4.35. The CAD is cut rates sub 4. So it's negligible, but it's still a positive swap if I'm holding long. So Aussie at 4.35, Canada 3.25. You get a 1% swap there. So you could get a few bucks if you're just holding long. So I will hold long. Same thing on New Zealand CAD. I'm holding long there too. You know where? I think New Zealand CAD is a little bit tighter range in the weekly time frame. But if I were to add more here, trade the range, look for a bounce there, or look for a bounce there, I'm just going to hold a New Zealand CAD, Aussie CAD long, and get some prices, like get some swap and get some profit. Swiss pairs, I'm still holding against the Swiss long. Let me go back to a daily time frame here. So again, for positive swap, this has helped me over last year. I generated over 20 grand in swap. So I mean, shouldn't matter because my goal is to make like 6 figures in profit, but I still generated a nice little chunk in positive swap and rollover. That's certainly better than getting it held against me and paying that. So at least it is worth hanging on to it for right now. If we don't have any major policy changes where right now the RBA is holding and the Swiss National Bank has made several cuts. So the Swiss National Bank has been cutting from 1.5. I'm trying to think where they went. They went from negative 0.75 all the way up to like 1.25, right? Is that what the switch was? I mean, it was during the 2000, trying to think, Swiss National Bank debacle was like 2015. Brexit was 2016. They went to negative 0.75 for a while, and then eventually raised rates into positive territory. They got all the way up to like 1.25%, I believe. And then they cut 20, and then they cut 50. So over the last year, they cut 75 basis points, now be at 0.5. Everyone has told me, like, Chris, I'm in the yen pairs for positive swap. Good luck. I don't want to trade the yen pairs. I don't care about the carry trade in the yen. I think it's a radical, wild, irrational currency pair. But the Swiss, on the other hand, a little more technically obedient, still offering positive swap. So I'm holding it long. So Aussie Swiss, I'm holding long. Okay. Where do I want to see the Aussie Swiss go? I want to see it get back up towards 6,000. I've got a measure move here. If we have a double bottom, I like this trade. Go back to the center. A lot of resistance up there. So I mean, I will wait and see, like, where does this go? Does this get worse before it gets better? Maybe. And if it does, I will just stay small and stay patient and dollar cost average in, find a low, and then stack a bunch of orders up here with buy stops to be right and get a bigger profit target. So I'll wait. I mean, it's really a stupid trade. The only thing I've got to show for it is a bunch of positive rollover, but I haven't come near my profit target yet. But when this is all said and done, I might be able to make like $200,000 or better on some of these Swiss crosses. Not this individual one. I'm saying like I'm Aussie Swiss, CAD Swiss, New Zealand Swiss, Pound Swiss, Dollar Swiss, long. So dollar Swiss, if it closes out for profit, that one's already, I'll check that one off the list. Cool. Because the dollar's been so strong. But Aussie, CAD, Pound, New Zealand, Euro, that's 5 other currency pairs that I'm long in. If those hit my profit targets, like there's lots of profit to be added up. But it's been a trade that I've been in for 2 years. So I guess I'm patient. You know, maybe you're going to call me irrational and silly that I'm holding the trade that long, but I do use Forex as an investment vehicle for that exact reason. Like normally I would say that trade should take me like maybe 6 to 12 months. It's now going on 24 months. I'm okay with it. I'm still getting positive swap. My drawdown is still very controlled. Does it get worse before it gets better? Possibly. You know, maybe I'm like last man standing when it's like this market gets worse, takes out this low, flashes below, and then comes back up for a big swing. And I'm still going to be surviving it and making a lot of money on the way up, but I've got to be ready for more pain ahead. Is that the play? I don't know. Maybe, right? Okay, Alpha. Yeah. So, were you in my live class this morning? I did a live class this morning at 9:30. You can email support@prosperitypub.com. Support@prosperitypub.com if you need some assistance there. But I just did a live session on that this morning. We'll be live again tomorrow at 9 o'clock Eastern time. All right, Aussie Swiss, we're good there. Aussie Swiss, fine. Aussie New Zealand. I'm long in Aussie New Zealand just to revisit these highs. We have had a pretty decent channel to the upside, and I think that this, high is potentially the target. I'm not necessarily going after this high. I'm just looking to see, do we take out that intermediate level? So if this goes up to a higher level, I'll take some profit. Um, I mean, I guess like if the Aussie New Zealand gets up to 114 or 114.50, I will probably look for a topping pattern and maybe short this thing back down to like the 105 zone. I think this is a really good like range bound currency. I'm just trying to figure out like where are the big levels to trade it. Okay, Aussie dollar. Aussie dollar, dollar is stronger, and you can see that this move got faded hard. So I'm just waiting. I'm scaled in for 3 positions, very small. Actually, take that back 2 positions. I've got 1 position here at 6,000, which is a bit lower. I'm pretty small on the trade size, and I'm going to ride this out a little bit longer. I've told traders this, like if I get trades 1, 2, and 3, I'm also prepared for like trades 4 and 5 down here. And that's probably going to be where I would say my anticipation trades are going to be there. Now, my confirmation trades would be waiting for better price action down here near that like 5,600 level. And if that bounces back up, I'm willing to sacrifice like 1 or 2 trades up here and then turn the rest of these trades into winners. So I'm going to ride this thing a little bit longer. It's a negligible swap right now since the Fed is cut. Aussie's at 4.35 and the Fed is at like 4.25 to 4.5. So swap wise, it's pretty much a wash, which is nice. I'm not getting charged for the Aussie dollar. But where's my technicals? Like dollar index, I expect to still be a bullish trend. I think it's going to be like a painful trend this year, and give the dollar like 6 to 12 months of additional strength, and then just short the living crap out of it. I mean, look, believe me when I say like the dollar, if it like once it's done and it runs its course with all the strength and it sucks up all the liquidity in the global economy, the dollar is going to be one of the best shorts that you can imagine in the next, let's say, year or two. So I'm on like team short. I want to short the dollar for a bigger trade, but it's not ready yet. So I'll wait. So what am I doing? Like in the interim, dollar strength has been dollar CAD long, dollar Swiss long. I'm in early, and I know I'm early on Aussies. I know it. I'm way too early on Aussie dollar, and I'm way too early on New Zealand dollar. Fine, I can ride those out. Euro dollar, I've told traders like if you're short on euro dollar below 105, you're probably going towards parity. Okay, if we go towards parity, great. If we go through parity, awesome. Protect your profit. But that's where I'm looking at. It's like I'm not going to chase this thing. If I wanted to sell this, right? If I wanted to sell, I would sell and sell and sell with a stop loss above 106, right? But do I love that trade? It's like no, because I missed it from 112. So I'm already 900 pips behind. It's like I'm not going to sell this thing now and just catch like the last little chunk of it. I'd rather wait for this thing to be at parity or lower and to get more attracted to a oversold condition with divergence, look for a bottoming pattern, and then trade the thing back up for a correction. I'd rather trade that. So I don't care about the next 300 pips. I care about, do I get a bottom that's going to be 6 to 12 months long that I can trade aggressively and make a lot more money versus chasing the last 20% of a trend. Okay. So that's that. Yen pairs. Okay. I'd rather go to the dentist than trade the yen. Sounds bad, like I don't go to the dentist, but I guess I'd rather have a root canal. I just don't care about the yen. I think it's just a silly currency pair that doesn't make any sense. You get like one good move a year, and if you're on that move, great. Most traders are on the wrong side of that move, and I think the yen is still stuck between that August deleveraging that we had. So I could see the Aussie yen doing this and doing this for a while and being just a terrible grindy currency, and then we have like a bigger move coming later. Again, if I can time it, I would rather trade the bigger move. I just don't know when that's going to happen, and I'm not going to sit around holding my breath. So I'm out of the yen pairs. Like, I don't care what the yen does. The only way I'm trading the yen is through the 6J, which is futures. Japanese yen futures is about the only yen trade that I care about. And it's not quite at the level that I want it to be at, but if we revisit this area from July of last year, which is where we saw that deleveraging, I mean, man, I want to get long Japanese yen futures. You know, I looked at 6J here. I'm trying to do some bull call spreads. So 6J there. The only problem that I have is like I can only go out to September. I hope that we get to fill these in and I don't feel like I'm missing the move. I'm trying to think. If I go out to September and let's go, this is getting, all right, so I'm going to switch this around. So my typical, I'm going to do a bull call spread. So this would be my low end of the option chain, high end of the option chain. If I buy and sell, I mean, this isn't a bad reward to risk. I could take this trade here for a $250 risk for a $375 reward. Directionally, I just need to see if I'm right. Now, this would be out to September 2025. So if I took this trade, the good thing is I give myself, 239 days to be right, which is cool. I give myself defined risk, which is fine. And that way I could be dead wrong in the Japanese yen and only risk $250. It's a lot easier than getting flashed out and, seeing like Bank of Japan intervene the Forex market. It's hard to control your stop losses when there's no liquidity, right? But at least with this position, it's defined risk. There's no assignment risk. I can take that trade. Now, maybe I do something along these lines. If I buy this call and sell something against it, like a $600 risk for a $1,200 profit, I don't mind that trade. Okay. A $850 risk for a 16. It's like I get essentially a 2-to-1, which is fine. And the nice thing is even in this position, if I was right directionally, if this goes my way, I don't have to hold this thing for max profit. All I'm doing is if I'm right on this initial long position, I have max risk at 850, but I think I could pretty easily turn this into like a $400 profit or an $800 profit, and I could just take a partial of my max. Does that make sense? So to me, this is like the safest way that I'm going to trade the Japanese yen. Defined risk. And I'm only able to do it through options. I'm only going to do it through the futures market. That just takes a lot of the stress out of trying to trade something like the Japanese yen, which is like my absolute Forex nemesis. You know, rather than trying to be like, the definition of insanity would be doing the same thing over and over again and not getting the result you want. That's what I feel like trading Forex, especially when it's like, when are they going to intervene? When are they going to intervene? When are they going to intervene? How is that possible to trade? You're not in control, right? You're in control if you can define your risk, which is what I'm doing. All right. So, is it better here? Now I risk 1,000 to make 2,000. It's about the same, So this is what I'm debating. Is it something that happens this summer? It's like I would like. This would be my ask. Would be going out to September. Like, isn't really long enough for me. That's the crappy part. Now I don't have to trade futures. I could trade something else. Let me see what FXY looks like. I can go out to 2027. Let me take a look at FXY. So we're back down near, it's similar. You can see the similarity between the Japanese yen futures and FXY. I could establish a trade where I could buy like this deep in the money call. Price trade at 58.30. If I buy a $40 call out to January 2027, that's going to cost me about $2,100. Okay. So if I buy this and I go out, I'm going to go out to January 2027, which means all of this year, all of next year, I think the Japanese yen has a move that gets Japanese yen strength. Okay. I think that's a pretty big window to say, I think I could be right directionally, right? Am I going to pay a lot of money for it? Yeah, I'll pay a lot of money for that. This is a 91 delta. So if I'm right directionally, this pretty much turns into a full, like every dollar that the asset goes higher, I get $1 of extra value to my option chain. Okay. So that's not bad. Now this gives me a break even around 61.60. So if I sell against this, and I'm going to look at this trade tomorrow because I might just take this trade. This might be better and easier than trading futures. Even though I like to make more money in futures for the income, this might be an easier way to take the trade, put on a 1% risk, but turn it into an income trade for maybe $500,000. Okay. So if my break even is 21.60, I can sell against this, let's say, maybe go out 70 days. And if my break even is $61, I can sell, never mind. And maybe this is what turns me off from the trade, is like the premiums are just not good enough in the near term. If I go out to June and I sell like a 64, so I lower my debit to $18.93, so I'd have a $40 call plus $18.93 gives me a break even of $58. I get it called away at 64. I get $500 of profit on a $1,800 debit. So 507 would be 507 divided by 1893. I'd make 26.7% return on my risk. Okay. And could I do that in the next 160 days? Sure, maybe. Could I roll it? I mean, I guess the good thing is, like, I could turn it into an income trade. It'd be pretty straightforward. It's easier to get the longer window. Okay. The downside is if I can't roll this for much premium, I can't really increase my profit target. And so rather than just saying like, I'll just buy it and hold it, it's like I'm going to actively sell against it to lower my cost basis. So let me think about that. We'll talk about that more tomorrow. Right? Is that case dollar cross longs would give you a negative swap? What currency are you talking about there? AC? Is that, I mean, so the only way you don't have swap would be if you have, that'd have to be an arrangement with your broker, right? Since 2023, swap has been a thing, positive and negative. So if you're holding, anything against the yen long, you make money on swap. You're holding anything against the Swiss long, you're making swap. Dollar versus like CAD, dollar CAD long, positive swap. Aussie CAD long, positive swap. Aussie New Zealand long, positive swap. Aussie New Zealand, right now, New Zealand is still at 4 points. So Aussie New Zealand long, very slight, but positive swap. So brokers should be off. It's like liquidity providers pay the swap to brokers. Brokers then pay it to us. And it works out to be the proper percentages of like, okay, if you're holding, dollar at 4.25 versus CAD at 3.25, if nothing happens, you should get a 1% per year. So this is essentially like a 1% win, and price doesn't do anything. If you hold dollar CAD long, you're making 1% on that money. So that's why with the Swiss crosses, I'm hopefully getting a bit more. It's like 3 to 4% swap, because the Swiss is at 0.5. I've got the Aussie at 4 and change, so that's like 3.8%. CAD is at 3.25, so that's like 2.75%. Euro is at 3%, so that's 2.5%. The pound, so UK is at 4.75. That's a 4+% swap. The dollar's at 3.75% swap. New Zealand's at 3.75% swap. So, like I said, between 2 to 4% swap if I'm holding against the Swiss. So if the pips don't give me any money, I still make about 2 to 4% on the investment. Okay, could be worse. I could be getting charged for it. So for all the bold traders out there that are like, I'm short the yen, I want to be short dollar yen, I want to be long the yen, I think the yen's going to get stronger. In the currency market, if you are charged swap and you're charged like negative 2 to 4%, believe me, it adds up fast. I know, because I was in a stupid position in 2022 against the dollar yen, and I paid, on top of losing some pips and then having to fight my way back, I did get a lot of negative swap that was really pissing me off too. Okay, so anyway, food for thought. Dollar topped out. I don't think. I mean, the dollar's not going to top out based on swap. The only way the dollar would top out here, make it less attractive, would be if the Fed cuts more. Then maybe, right? If the Fed holds, I could see the dollar maintaining bid. If the Fed starts cutting like second half of this year, maybe that's enough to say, okay, the dollar's had a good run. It no longer offers the same carry opportunity as before. And sure, maybe it makes more sense fundamentally that the attractive holding of the dollar isn't what it was. And so maybe that is like the second half of the year, right? If they cut rates by 25 or 50 basis points again this year, and all those central banks are kind of holding tight, makes it less attractive. Maybe that's what we get the timing of it, right? But I don't know. Until then, I'm not fighting the dollar. Okay. I say that, and I'm early on Aussie dollar, New Zealand dollar, so I am fighting the dollar a little bit, but I'm fighting it small on those two currency pairs. But the other side is I'm long dollar CAD, long Aussie, or I'm sorry, long dollar CAD, long dollar Swiss, and those trades have worked out really nicely. All right, gold, silver, dollar. I saw the question on Trip. I don't even know what that stock is. Trading at $15. Trip Advisor. Okay, so this would beg the question for me: why is this stock down 87%? We've had a 2.5-year bull market. Why is it down 87%? I don't know. I look at it. I mean, again, I know TripAdvisor. I don't have a position in it. I do like what it shows me already fundamentally. We've got financially healthy. Past performance is okay. Future performance is meh, but there's no dividend. There's no value there. Let's see what it says for fair market. It's already like 58.4 times price to earnings. That's a little high, but obviously in like the tech world, that means nothing. Fair value at 66. That's pretty darn attractive, if you ask me. So defined risk on TripAdvisor. It's like, what happened to the stock? Like COVID, okay, so COVID, we had the crash and then we ripped up, but it's like, what is happening fundamentally for the stock to be so trashy? Like even post-COVID, why is this thing down 80% post-COVID? So that's my only concern is this a stock that's so cheap that it's a buyout target? So I don't know. I mean, otherwise I look at a stock like this and say it's risk capital, right? If I was willing to say, okay, I'm going to put $1,500 on this stock, and if it goes up, it's all gain. If it goes down, I'm losing $1,500. So it's either a zero or it's a lot of upside potential. If fundamentally this says, $50 to $60 of fair market value, and this thing can go from 15 to 50, cool. But when and how does it get there? And why has it not had any type of signs of bullishness? So my only concern is that whatever you put at this could be zero. So make sure it's something that you can afford to lose. Synthetically, if I looked at a position that wouldn't cost me a lot of money, let me look at Trip here. And let's say I go out to, I don't know, let's give it the entire year. Let's give it the year. Well, if I buy a call at 15 and I sell a put, okay, I can be synthetically long in this stock for a max loss of $1,500. Okay, and I say like it has to go to zero for me to take a max loss on it, right? If I do a one strike out of the money, so I buy one strike out of the money call, which is a 52 delta. I'd like to go a little bit deeper than that, but it is what it is. Or I do a 70 delta and then I sell an in the money put. Okay, I guess it'd be an out of the money put. Yeah. So this is fine. So I could buy the deeper in the money call, sell a put, or just do it. This is synthetic right here. If you do a synthetic long, then you buy the call and sell the put at the same strike price, and it looks like this. From P&L standpoint, it's exactly like holding the stock long. I didn't show that very well because it's black. It looks fudge. So from your P&L, it looks like this. As long as the stock price goes to $15.75, I make money on the trade, and it is making money all the way up. Okay. Now it's synthetically long, but is it a full like 100 delta long? Not quite, but it gets there fast if prices go in your way. Okay. So that would be the cheapest way to trade it, but you're still on the hook for the full $15 put to zero is your risk. But you have unlimited profit potential. But do I like the stock right now? No, I really don't. Yeah, you got some zebras on that? Okay, so you're buying the 70, selling the 50? Yeah, that's fine too. So you buy the 70 and you sell the 50, give or take, and then you buy two of the 13s. So there. So now you can be synthetically long this way with much less risk. There's no put side here. You're just long, and the most you can lose is this debit. So the most I can lose there would be $630 per contract. Still unlimited upside potential. It's not quite a full 100 delta, but it mimics it. So synthetically, you could be long that way. Again, not a bad trade. Costs way less than buying the shares outright. Way less risk because the most you could lose is your debit. But you need the stock to go up. It's that simple. So do I love it? I just have questions on why on earth has this stock done garbage performance for the last couple of years when we've been in a pretty solid bull market. That's my biggest concern. But could it be something? Yeah, maybe. But whatever you throw at it, be willing to say it's going to go to zero. You know? All right, that's it. Okay, let me go a couple more minutes here. Let's see. Swiss yen, I'm still holding. I'm break even on that one, or just about. Euro yen, somebody asked me about that earlier. I got the same situation on euro yen. I just don't love it. Euro yen, maybe just chop city for a while. Bigger. I mean, I look at it this way: this high, this low. I'd like to see the euro yen behave because we had such a big run for that positive swap trade that a correction against it would make a lot of sense. The problem is the timing of that trade. This all happened so fast. And if and when it happens again, it's going to be fast. The hardest part is going to be the timing of that, right? And I don't want to sit here and hold euro yen short trying to get the timing that I have no clue when it's going to happen. So I'm not going to trade the euro yen. I just don't want the negative swap. Okay. And I'll say this was not a good look for the market, right? If we had this again, it's not a good look for the market. There will be some risk off trading in the currency market and risk off trading likely in the equities market. You can see how close of a call that was August 5th, right? Like futures market went like haywire during that like late July, early August blip. It was just a massive volatility event, like the single largest volatility day we've ever had. So I'm not going to sit around trying to time this thing. And I'm not going to call a position that I think technically would be going down. Like this position has been going up for 5,000 pips. And so a correction against it would make some sense to come back to equilibrium. Problem is, I don't know how long it's going to take. So I'm not going to sit around and wait for it. Right? Let's go oil, gold, silver really quickly, and then I'll wrap it up. Somebody asked why the market's closed today. Jimmy Carter, former president U.S., died at 100, and so in honor, they've done that since it's happened every time a president's passed away since Lincoln. So it's always like a day of recognition, day of mourning, and that's today for Jimmy Carter. So here's oil at 74.19. I had mentioned just watch out for the fake out trade. If oil is going to kind of hold here and break higher, then sure, oil is potentially looking better to be bullish. I don't love the trade right now because I think we still have to prove that it's going to go up. Again, inflation, which will come out next week, is inflation showing higher ticks or lower ticks? What's oil going to do as a response to it, or what's oil going to do ahead of it? I don't know. But oil higher, probably not good for inflation. Oil lower, okay. We'll see what the numbers read next week. So Tuesday, Wednesday next week, PPI, CPI, better, worse for the US. We'll see what the trend is. Okay, gold and silver. We had a lot of conversations about these yesterday. Gold is maintaining a pretty solid bid here. Doesn't mean I want to get long. I still like the bar count. I still like a high-low correction, high-low, lower high, lower low. I'm trying to hold on to gold for a correction or trying to be patient to add more to it. The problem is I might not get it. I might get something like this instead. Maybe gold just stays bid, gets back to the highs again. I'd love a range if that's possible. Like maybe I don't get a breakout trade, but it comes back one more time. Then I can buy some gold, and then we go back to here. There's no such thing as a triple top, and all of a sudden we break and go higher. So I'm just going to hold out and see like when and if it hits the 200 moving average, I'll be looking to add positions to it. I still like silver better on the technical side, and I'm hoping that silver, I put on an SI position yesterday, which is down here. I'm hoping that silver will make its way up and then make its way up to my measured move. That's a big profit target. That's terribly drawn, but profit target at 35.88 on XAG. I'm trading silver futures. There's the trade. There's my take profit. It's a defined risk trade. So if I'm right, I think I make like $300 if I'm right. That's an income trade for March. I might continue to do that. Like if silver stays like really choppy, then I might continue to do trades like this and stagger them out over a couple of months. But directionally, if I get SI, SLV, I still have positions in both. And I'm looking at SI for more income trades, SLV for more holding. I want to hold SLV at least to like 35 bucks. So actually what I could do is look at a covered call. This will be better for tomorrow when the market's open. But I do have SLV is up. This is year to date. This was up like $40 or $50,000 last year. So this is a pretty good chunk of profit. I still have some shares, and I no longer have my covered call. So what I might look at is if I can get like a $35 or $36 covered call. I don't want to go out too far. So I just want to see if the premiums are okay. Maybe getting like 50 cents to $1. Let me see how far I have to go out. So if I went out to end of March, 35 bucks. I mean, the premiums are garbage, right? Like 13 cents, that doesn't make me excited at all. So I'm better off letting the stock itself appreciate in value and then adding the covered calls, because then at the money I get like $1.54. So if I'm willing to like let the stock go, then I probably just let price appreciate. If I want to go a little bit farther, let's go to summer, June. A little bit better. I go out to $35 or $36, get 45 to 50 cents on it. Like that's okay. But I'm also, what happens if price does make a run to 35 bucks and I'm like, well, crap, now I can roll it. So anyway, it's just, if I went out to the end of the year, is it even worth it? Go out to the end of the year and my strike stops. This is stupid. My strike at December 31 stops at $34 and there's no bid. So I'll see what this looks like tomorrow, or just go out to the next month. January 2026. Now I've got more strikes. I can roll this. I can go up to 4. I mean, that's not bad. If I get $1, right, 92 cents or a dollar, and I can get my my SLV called away at $40. Okay, or I can just let this be income. I don't know, whatever. It's something I'll just kick around. My covered call has lowered my cost basis. Let me see what I own. SLV, I own it. And where's my break even? SLV. I own the shares at $25.79. So my break even is $25.79. Okay. So 33, fine. Full measure move is 44. If I'm really going to let my entire position go, it's going to be up in the 40s. So I'll play around with that. All right. That being said, I'll let you go. Markets are closed. Enjoy the time off. Whatever. We'll come back and do it again tomorrow. Let's find some trades. All right. Thanks, everybody. Have a good day. Bye.
Thanks for watching today's A1 Trading Show. We hope you enjoyed, and we're excited for a brand new year of trading with you. If you're new, consider subscribing for daily videos and live streams all year long. Be sure to check out the description below for our latest deals and offers. 2025 is just the beginning of our best year yet. We'll see you tomorrow.